Welcome to this week's Market Mondays webinar. My name is Kyle Rodda, and with me this week is my counterpart, not from the UK, but from Dubai. It's Monty Safedeen. He's our analyst in, well, Middle East, covered predominantly, but obviously we all take our turns analysing different markets around the world. Monty, how's it going, mate?
Doing good, Kyle. Hope things are well on your end.
Certainly are. Certainly are. Great to have your company. But before we dive into things, of course, this is Market Mondays. As I said before, we'll just I'll run through very quickly the risk warning just to make sure that we're fully compliant and get across all that important information. And that's just to say that, of course, CFDs and if you are in the UK, spread betting are complex instruments. They are risky. You should consider your risk profile before trading in these products and obviously seek out advice independently accordingly if you need to assess your own personal financial situation. For the Australian clients, of course, this is just to say that the information that you hear in this webinar is of a general nature only, and it doesn't take into consideration your personal circumstances. So please take that into account. Very, very important. But alas, we can push on. Now, just going across over some of the big events over the last few days, and of course, this will inform how we start the trading week and some of the events in the week ahead as well. A bit of a focus on US jobs data. Very interesting dynamics there, especially as it relates to US rate cuts. That'll dovetail into a chat, perhaps briefly, about US inflation figures coming up in the week ahead, what that might mean for the Fed as well as broader asset prices. We've also got the ECB this week. Might be a bit of a nothing burger, but it's worth touching on. Oil prices as well is something in focus, not just because of the macro story specific to the US economy, but of course, the supply side of things as well. And we won't necessarily limit things to just those five topics, but just a bit of a lay of the land as we start things off for the week. And Monty, I thought I would initiate the conversation with just a look at what is the CME futures, I should say CME Fed Watch tool, because if we look after the jobs data or at the jobs data on Friday night, weaker than expected, unemployment rate ticked up as expected, concerns about the health of the US labor market, and there's the very slight flirtation, as you can see here, of a 50 basis point cut in September. Again, it's really just a very, very slight flirtation, but perhaps sort of tells a little bit of the story. And I'll throw it back to you, Monty, about, like I said, the lay of the land at the moment, that we're on Fed watch, a cut's expected, and the question is perhaps how much and then how many from here.
Yeah, and I guess that from our end as well, that's something that we've got a lot of clients as well asking about that sort of situation, because even on a personal level, a lot of them going, okay, when is the payment going to come down? When am I going to get rate cuts and things like that? And I think that if you look at what a lot of the Fed members were talking about before, the way they were talking was more of a cautious, oh, we're not so sure we want to cut rates just yet. Hold on a second. Labor market, even when the unemployment was at 4.2%, one of the members came out and said, oh, well, it's still historically low. And if not mistaken, it was Fed's Goolsbee that came out after the results and still said that he's still undecided regarding September, just because he wants to make sure that services inflation isn't just a blip. But I think generally speaking, you're right, in terms of CME Fed Watch, you went from via majority anticipating a rate cut to definitely, fully pricing in one, and some even gunning for 50 BP. I think that you're still going to see division in the September meeting among the FOMC members. And I think that from here on out, from the last meeting onwards, we should expect to see division among FOMC members. And of course, this is obviously gonna make things a little more entertaining. I'm usually used to FOMC meetings where I have to have you kind of need a cup of coffee to stay awake. It's at 10 p.m., 11 p.m. out here by the time the results and the press conference. I think we're gonna have to go from a coffee to stay awake to grabbing my popcorn, because I'm expecting division. I'm expecting difference of opinion. I'm expecting some sort of a lot more entertainment here on out.
Yeah, without a doubt. And I suppose if you do look at that, potential split between hawks and doves, and if you want to get a bit of a sense of what that might look like, you don't have to do that yourself. Fortunately, President Trump on Truth Social a few weeks ago made it very, very clear who he thought were on the dovish camp. Incidentally, those that he says that he selected to the board versus those who might be considered a little bit more neutral in their bias. I don't know if there's anyone necessarily that would be hawkish at the moment. Obviously we have Powell and a few others perhaps suggesting that we still have to watch out for inflation. There's the one-off price level changes possibly coming through from tariffs. But if we've got this weaker labor market, which, clearly there are concerns now that the official data will continue to come in weak, a little bit like on Friday night, we'll continue to see downward revisions on the numbers that we've already received, and obviously will be revised over the next couple of months. Christopher Waller, obviously gunning for the Fed chair role, and I don't think he's acting in bad faith personally, because he has been banging on about the labour market deteriorating for a little while and put a really cogent case together a few weeks ago about it. But he might come out and, like you said, Monty, in terms of division, if they don't go 50, he might vote for 50. It might be in his self-interest to vote for 50. Michelle Bowman might vote for 50. And all of a sudden, the distribution of risks when it comes to policy sort of changes, and that kind of adds a little bit of uncertainty into markets, I guess.
Yeah, it kind of reminds me a little bit of, for those of you out there, like if you look at other central banks and stuff, the Bank of England is probably the one that
Mm.
comes close to mind in terms of the division that we saw. One would go for a hike, another says, no, we want to cut, the other says, we want to on hold. So a lot more division compared to before. And I think we're going to be in this period, not just for the US, but globally, where there's going to be division moving forward, just because now the real trade-off starts. Before, after the pandemic, it was a situation where, okay, they want to boost the economy, put fiscal stimulus, monetary stimulus, they just threw it all out there. You saw unemployment rates come down, great. So that part of when it comes to the Fed, they're given their dual mandate. That part's done. Inflation went up, so now we got to tackle inflation. We went through this period where, when it comes to the labor market, there was always weak data points under
Mm.
the hood, but it never really came to the surface. And I think now it's finally starting to come to the surface. I mean, like you mentioned, the revisions. I think the BLS also has got the revisions for the up to March 2025 tomorrow, releasing tomorrow, if I'm not mistaken. So, like,
Yeah.
those revisions should make, that will finally not just say that, hey, the people out there who were saying things were weak, look at that. That means they were right all along. But that should really solidify that, look, finally it's bubbling to the surface. You finally have to at least address it. You can no longer say what they said before for many months, that labor market is still strong, even when there were those within it crying, going, oh, hold on a second, it's not that strong. There's this, there's that. I think it's finally gotten clear where they've got a real trade-off to make. And that's only gonna, I think that trade-off is only going to become more difficult for them, which only means ongoing division.
Yeah, without a doubt. Well, we'll talk about the market implications in just, a second. But, I wouldn't mind sharing another kind of insight that I kind of heard from, I think it was Barkin. Is it Anthony Barkin? I can't remember. Also a governor of one of the regional feds, I believe. But he was talking about how, in principle, monetary policy is easy 90% of the time, because if inflation's falling and the labor market's weakening, you cut interest rates. If the labor market's tight and inflation's rising, you hike interest rates. But we're in this environment now of, supply shocks and a great deal of uncertainty as to whether things, for example, like tariffs, are going to kind of work through the economy and lead to a permanent re-anchoring of inflation expectations and all these sorts of things, rather than perhaps just this one-off price level change. And in those situations, the job of a central bank is actually very hard, because you're faced with, obviously, that trade-off between keeping policy a little bit too tight and hurting the labor market, and you get this kind of, growth slowdown. Alternatively, you cut interest rates to support the labor market, and you could potentially compound the inflationary risks that exist in the economy, either because of inflation expectations becoming unmoored, or just simply because some of these, supply shocks are kind of slowly working through the system, which, it has to be said, obviously is why, for the first 6 or 7 months of the year, or part of the reason why for the first 6 or 7 months of this year, the Fed have been so reluctant to cut interest rates. The labor market at that time, the perception was that it was in a strong place. But the other thing was that they didn't want to move too soon, out of fear that, they turn a one-off price shock into something a little bit more persistent. So a really, really difficult situation. The Bank of England one's obviously funny, because they had to go to a second round of voting last time. And so one hopes that, the Fed won't be that chaotic at this particular decision. But when it comes to the market response, Monty, I'd be keen to get your thoughts. We saw some predictable things. The dollar weakened a little bit, not by much, but it weakened a little bit. Gold prices are at a record high, and we can maybe pick that out a little bit more in a second, because someone will inevitably ask about it. But equities dropped, but not by much. Tech actually held reasonably steady. And my perception is that, despite the fact that we're getting this weakness in the labor market, there is the view that the Fed isn't too far behind the curve, and with a little bit of policy tweaking, maybe can support the economy enough to avoid a significant slowdown, and therefore a re-rating in stocks. What's your sort of view on where we're at here, especially considering valuations are pretty expensive, right?
Yeah, that always comes up time and time again. People just keep on saying, well, hold on a second, valuations are very, very high. But the thing to remember is that, if indeed, and we don't know exactly where the Fed funds rate is going to settle, but the US president is pushing for 1% or even sub 1%. Gets there, doesn't get there, besides the point. But if indeed we got something close to 1%, if you look at where forget treasury yields for a second, which I know they dropped, which means the markets are saying they're more concerned now about labor than they are about inflation when it comes to the 10-year and above. But you look at for the S&P 500, for example, put aside even the earnings yield, you look at the dividend yield, it's about 1.2%. So if
Mm.
indeed we're talking about eventually interest rates being very low, 1% or getting close to that, I'm not saying again, I'm not saying that it will happen, but then from an investor standpoint, doesn't that mean that everything from bonds to stocks are relatively cheap? Again, I'm not saying that. I'm not trying to again, don't forget, guys, the disclaimer that Kyle read out at the beginning of the webinar. But that's, I think the problem is, even when I look at the weekly investor flows from the Lipper, the flow show and things like that, they're still not really getting.
Oh, I may have lost me or Monty there. Hopefully comes back in just a moment's time because we it was a very, very interesting insight. Can I just make sure that people can send me just a very quick, you can hear me, just to make sure it's only Monty and not myself. Obviously, Dubai is wonderful for many things, but maybe Wi-Fi is not as good. There we go. Okay, I've got that. I'm audible. Monty has a very unfortunate freeze frame. Well, perhaps we'll just leave Monty there at the moment. He hopefully will come back in a second's time. There he is, Monty. Sorry, we lost you there for a moment, mate. Are you back with us?
I'm back. I'm back.
That's okay. Dubai, I
Um,
was just saying, Dubai's an incredible city for so many things, but maybe Wi-Fi is something they still haven't caught up with yet.
I think they said some undersea cable got the past couple days it made to the news, and that's why the internet got a bit choppier. But normally it's awesome. But
Oh,
just, yeah,
right.
this happened.
Okay.
Yeah,
I gotta
I'm not
stop.
going to delve into that because I don't touch geopolitics. But yeah, that might explain why.
I haven't heard that. Yeah, well, I don't know if you've made too many enemies, mate. I've got a few out there, so maybe they're trying to undermine our webinar specifically. That was their motive. I think we got to the point where we were just talking about, well, this isn't advice, but you were talking about, valuations and to what extent that perhaps, given a few assumptions, perhaps stocks and bonds aren't that cheap at the moment if we assume perhaps a federal funds rate of say 1%.
That's right. Yeah, and then I was also going to add that when it comes to the weekly flows, I don't know if that got cut off or anything, but when it comes to the
Yeah.
weekly flows, that okay, even in the weeks where you have outflows, I mean that's the nature of the business. You got inflows and outflows. It's not always going to be successive inflows or outflows, but even the weeks where you have outflows, it's not that large, not something where you want to be afraid. I mean, yes, there are moments where people put a protection or a partial hedge and stuff. That's normal, but nothing that really screams like investors are saying we want to get out. So I think that, and then you also have to factor in that if indeed we're looking at inflationary situation or where the Fed is going to be cutting rates or some sort of easing, doesn't that mean you kind of want to be in it and not
Mm.
out of it when it comes to traditional assets, especially with investors still having excess cash? We're not talking about the retail crowd or consumers. We're talking about when it comes to actual investors and money market funds, still a lot of cash left over from the pandemic days. So I'm not so certain. I'm not seeing a situation where investors are necessarily wanting to get out in mass, and that's generally a net positive for risk appetite.
Yeah, totally. It's an interesting perspective on just the flows there, isn't it? Because like you said, we've got, valuations reasonably rich at the moment. But again, if the Fed wants to run loose policy on a real basis, because that's the new way of doing things, then stocks have to go up. And incidentally, maybe we'll move on to just another beneficiary of that kind of dynamic, which is gold, and probably explains a little bit why we're seeing gold prices so elevated. Maybe even, Monty, I'll share my view on things, which is to say, obviously, it's interest rate cuts and Fed independence. Interesting data last week as well. Actually, might have even been this week about China's FX reserves and the composition of their portfolio being much more significantly moving into gold once more. So those, central bank buying ramping up even further. We even saw conversation about India's FX reserves being sort of diversified into non-gold assets, sorry, non-dollar assets as well, really trying to get away from the US dollar for a variety of reasons. But it would seem, another market at record highs, all the fundamentals are basically tailwinds at the moment, very, very strong tailwinds. Any insights from your perspective on the flows and the technicals there? Because from my perspective, again, interest rate cuts, uh, institutional instability issues with credibility, potentially unsustainable fiscal settings, a little bit of de-dollarization, probably made worse by trade policy. I think, did I say geopolitics? Maybe not. Geopolitics as well, always an ever-present risk. I mean, everything seems to be going the way of gold at the moment, right?
Yeah, and if you look at okay, if you look at it from a sentiment standpoint, traders on our end, they're usually want to be majority buy when it comes to gold and oil. They like to be long. They look for an excuse to go long. But when you have such a big run up and it goes up, obviously they want to take profit at some point. So they take profit, and so you see long buys drop significantly. It was extreme buy 78, 80%, and now it's down closer to the middle, with any further gains likely to entice some of the longs to get out. Now, whenever there's a pullback, they obviously want to get back in, because net, they expect prices to go up. So they try to find ways to go back in again, which is always a risk whenever you see a sort of pullback that might be larger. Now, from COT speculators, which is from the weekly COT report out of the CFTC, they're extreme buy in gold. They still are. Latest figures were released last Friday, positioning is as of last Tuesday, and they've actually taken it up a notch to about 83%. So that they're very extreme buy territory. Silver, by the way, they took it up to 80%. They're finally in extreme, what I like to label extreme buy territory. The thing, all those stuff you mentioned on the fundamental front, excellent points. The issue then becomes when you want to sort of label, and this is what I like to do from a technical standpoint, sort of look at a market and sort of label it. Okay, what is it? Is it consolidatory? Is it bullish? Is it bearish? Bear trend stalling, bull average. On the weekly time frame, I give it bull average. For the daily time frame, I actually shifted it to volatile, and that means you're going for breakout strategies in either direction. The problem is when you get to record highs in gold, with all the factors that are happening, it just takes one thing to see a big move in either direction. And that means that the traditional levels that we're used to holding, they might hold on some days, and they have, but generally speaking, you kind of go for a breakout strategy because you're just seeing a big move in either direction. Like, would it surprise you, even with all the bullish stuff, would it surprise you if you saw a pullback of, say, $100 in gold? I don't think it would surprise anybody.
No, without a doubt. And I'm just sort of going back through the technicals here because I do like, especially on gold, I find it really respects the technicals. And Monty, obviously, you're our special guest for the week. But on previous webinars, we've been talking about this kind of setup, this kind of consolidation pattern that we'd been seeing in gold for a little while that just seemed to be sort of bound to break out. I mean, I suppose a critical thing for a trader is being able to sort of position for these things prior to the move rather than, obviously chasing it higher when risk reward becomes a little less attractive. And just perhaps to add to your kind of point there about maybe having perhaps missed somewhat of an opportunity on this time around, despite the fact that I think in the long run, I mean, the trend for gold is higher, and I think all those fundamental factors will continue to push it higher. Yeah, if you do look at it from that sentiment perspective, I mean, I'm getting calls about every day from journalists. When it's hitting mainstream press, it's normally out there in the world, in the ether already, and probably in the price. But if you sort of go back to these other periods where we saw, short-term snapbacks, I mean, the RSI looks pretty similar to where it is now, for example, on the dailies. And I mean, we have just pushed through 3,600. That's admittedly a milestone that we've just broken in the last few hours, literally since probably we started speaking, 3,610. But I suppose it's that kind of tactical thing, isn't it? Is that even though you've got that kind of directional bias, clearly the fundamentals are strong in a particular direction. We've just hit a very, very overbought kind of a zone here for the market, and it sort of raises the question about whether you should be chasing this or not effectively.
Yeah, and that's always going to be the fear because a lot of times, there are people out there who just look and go, okay, what hits a record high? What's going up? Let me try and latch on. And it does well, by the way. Gold, when it started moving up, I mean, if you latched on early, you didn't actually even need to get in early, because when it got to about the 34, what is that main resistance level around 3470, and then it got to 3500, you still would have gotten, there's about $100 move to go with it. So I fully understand why, there are those out there that look for a breakout move. Not going against that. I just think that you just got to be a little more cautious. Just expect that you could get bigger moves in either direction when you're at these levels for something like gold. And I think the bigger fear for me especially is, I'm from that time, and when I say from that time, I don't mean like 50 years ago. I mean just a few years ago, where gold used to track the inverse of real yields on treasury yields. You look at the yields. You take it, you adjust it for inflation. If it's positive, it's moving higher, that means gold usually is going to go lower because gold doesn't yield anything. What's so scary is that you had yields, we're in this phase where yields were going up. I know they went down late last week, especially after the NFP report, but we were in this phase where yields were going up and gold prices just defied that traditional formula that everybody was looking at, and it just went up as well. And so there's that fear. I know you mentioned those factors about Fed independence obviously put into play. You got that with the fiscal spending. If we're in this phase where a lot of governments are just going to be spending more, and they they cannot cut their deficits enough. They're just going to be, you got US, you got France now today with their vote of confidence, and you're in this phase where maybe a lot of people don't want to hold on to debt as much as they used to before and want to trim that. Well, what's the alternative if you wanted something relatively safe? If you're there, you've got the bond proxies, which did do very well on Friday, where the real estate, utilities, health and consumer staples. But then outside of that, you got gold. Yeah.
Yeah, I totally agree. Maybe that takes us just to that kind of key event risk of the week, or risk event, I should say, which is the inflation data. And I suspect it won't shift the dial significantly on September rate cuts. But as we noted, there is the question of 50 or not potentially in the next, well, in a week and a half, pretty much when the FOMC meets next. And then also what the curve is going to look like from here, because one thing that I think we can glean from the current situation, and I think has come through a couple of times when we're talking about, stock valuations and then also, positioning and what have you, after such a movement in gold, is that you get these kind of levels, and the momentum is very strong, but the markets all of a sudden become very prone to shocks, which is to say news that is surprising and can change the prevailing narrative, perhaps. And I think that would be maybe tail risk, because I think the estimates for the core inflation this week is at about 3.1%. But hypothetically, it comes in at 3.2, 3.3, just saying. That's the kind of thing that can spark that kind of, fairly swift reversal, right, in some of these stretched positions. Rate cuts come out of the market, stocks get a little bit panicky because we'll start talking about stagflation if that's the case, because clearly the labor market's not, contributing particularly much to inflationary risks at the moment. Or though should say there has been a little bit of a supply shock in the labor market too, because of some of these immigration policies in the States. But if we do get this kind of upside surprise, more as a hypothetical, it's the kind of thing that could see a pretty quick snapback in financial markets and some of these moves being unwound.
Yeah, very true. And I think that you mentioned stagflation. As someone who, my degree is economics, you teach economics. So that stagflation, that S word is a bad word. You put money in the swear jar whenever you say that word, because it's such a bad word among us economists. You're never ever supposed to say that word, but here we are saying it, and we're going to keep saying it. And I think that's going to keep on coming up. What's interesting to note is that, you mentioned that what if inflation comes out hotter than anticipated, because you got month on month 0.3%, both headline and core for CPI, and producer prices, by the way, that's going to be, in my opinion, also significant, just because last time it was 0.9%, this time the expectation is around 0.3%, both headline and core, which is, again, annualized, too hot for comfort when it comes to the Fed. But here's the thing, the ones who voted for a rate cut among the Fed members, what exactly are they saying? They're saying that this increases, that yes, tariffs will result in price increases, but it's going to be a one-time increase, which kind of reminds me of the transitory days where they went, yeah, inflation is going up, but it's transitory, it's going to come right back down, don't you worry about it. And I feel they're doing this, there's a bit of a repeat. So I think the members who continue to look at the labor market and want that rate cut, they're going to keep saying, even if inflation is harder than anticipated, they're going to keep saying it's a one-time increase, don't worry about it, but look at the labor market, look how weak it is. And I think that those specific members will do that. Now, you got the ones like Goolsbee and the others who I mentioned, they'll note services inflation. If they see inflation hotter, if they see that services inflation is sticky when the tariffs are supposed to be impacting goods inflation, not services, they're probably going to bring that up, and they're going to say, okay, you know what, I'm undecided about September, which once again further reinforces that divide that we're expected to see. So hotter, lower, I don't know if it's going to change. It will, you're right, it will mess with rate cut likelihoods, especially for the 50 basis point. It will potentially cause a bit of a shock to some parts of the financial markets. But I think when it comes to the Fed members and their reaction, I think they're going to come out calmer, and they'll just say, so as I was saying, I expect, I'm looking at the labor market, or as I was saying, it's a one-time increase, and we might get some of that afterwards.
Yeah, totally. And I mean, I think that's probably fair to say what Powell's position has been since the start, right? Is that he, probably because his legacy has been kind of tarnished already by that sort of transitory word a few years ago, and clearly, was blamed in part for the reason why we saw this, surge in inflation for a few years, that, the Fed had to subsequently work very hard to kind of contain again and muscle back lower. It's that he doesn't want to basically be known as a guy who made the same mistake twice, right? And his wait and see attitude, despite the fact that we've had these dubs on the board for the last, maybe 6 months, who have been very inclined to talk up the prospect of interest rate cuts, Powell's taken that much more neutral approach to things. It is that fascinating dynamic, though, where you talk about the stagflation thing, because that kind of whole notion of services, one thing that we should have, maybe noted when we were talking about the NFP's situation is how much higher the unemployment rate would be if we hadn't seen that drop in the participation rate over the last few months or so because of Trump's immigration policies, which has kind of kept the unemployment rate around the kind of low fours and notionally around full employment. When if we had a participation rate similar to what we saw at the start of the year, the jobless rate would be around the high fours, and we'd be probably much more comfortable talking about interest rate cuts potentially than where we are now. The flip side of that, though, and this is again going back to that point about um, central banking being pretty straightforward most of the time, but it's those situations when we could be seeing prices rising and employment weakening at the same time, is that it's generally driven by supply shocks. Those situations, and we are seeing a big supply shock in the labor market, which reportedly is also sort of adding to some of those pressures and services inflation. It's not just a demand side sort of demand side story anymore, which it has been for the last few years, just resilient consumer activity, that we're actually starting to see, basically a lot of services workers exiting the labor market because they don't want to be potentially shipped to another country. And that's sort of putting pressure on costs for some of those services sector to companies that then have to pass them through to the end consumer. Got a little bit obviously academic there, but let's very quickly, especially given your special place in the world, Monty, have a quick chat before we take it to some questions, if we may, just to the oil market, because I'm pretty bearish on oil just on the basis that clearly the demand side of the story isn't fantastic at the moment. But more importantly, there was already the perception of the building supply glut because of clearly that was deteriorating demand outlook. But the supply situation has been interesting over the last few months, and it's only got interesting over the last few days as well, because OPEC is planning, it would seem, an increase in production in October once again. It would appear that they're prioritizing market share, or at least some of the bigger players are prioritizing market share over price at the moment. I mean, while that dynamic persists, and clearly they're more comfortable with a lower oil price, I mean, it's sort of seems to me one that's going to kind of lend itself to perhaps another test of somewhere around 60 in the short term. Do you agree, or do you think or would you take the other side of that trade?
No, I actually, no, to some extent, I agree. And what scared it a little more was because you always look at oil and you kind of think, okay, where would an oil producer like to see oil? Obviously, they would like to see it higher. But where would the average oil consumer like to see in the oil consuming nations or net oil consuming nations? They obviously would like to see a lower. So it's always that matter of, okay, where would the US like it? And then where would sort of OPEC plus the producers sort of like it? And it's interesting is that what do you call Trump recently said that he sees oil prices breaking below $60 soon. So
Hmm.
that means that signifies two things. One, of course, people are going to be like, "Oh, wait, does he know something we don't?" So let me go ahead and get. I'm not saying you should get in on that trade, but when he said that, it's also the matter of he's comfortable then with below $60 because he also has to worry about the shale producing region and those within his camp who are who would like to see higher oil prices because they're oil producers in Texas and so on. So the fact that he came out and he was saying that, yeah, to see oil prices below 60 pretty soon, that's something that means that he's okay with that. And that would, to me, then I would not be surprised at all to see it get below $60. Now, COT speculators are still net long, but they're nowhere near what was, they used to be extreme buy around 80%. Now it's closer to 60 some percent. But I don't think that matters as much. I think within oil, you always have these little mini trend moves where countries are comfortable with oil prices being, generally speaking, the producers and the consumers. And it wouldn't surprise me then if we actually got them to be comfortable with a lower range just after the comments that I got there. And of course, you're seeing, of course, forecasts from the likes of Goldman Sachs, all starting to forecast much lower prices for next year. So barring a significant shock, I know everyone's looking at the secondary sanctions story, but at the end of the day, if indeed India keeps buying it, for example, as they intend to, then you're not really talking about a big chunk of supply being removed from the market. And that just means that with OPEC plus raising output and not a significant amount of that of oil producing countries being sanctioned properly to the extent that that oil gets removed, well, then basically you're looking at more supply base. And at the same time, of course, you got to worry about demand, as you mentioned, especially with now the labor market in the US weakening and just globally when you look at trade and things like that. So yeah, it wouldn't surprise me at all to see a move lower. How it gets there, we'll see.
Yeah, and that's the thing. I suppose when you are talking about cartel activity, it's sort of up to their just sort of discretion and the dynamics around that as to where things potentially go next. So we're always sort of one comment away from a pretty sort of whipsawing move there. But for me, that sort of 65, we had that kind of false break last week, I think. It sort of tested that 65 level before we sold off. Maybe a bit of sort of around 62 on the downside seems to be a bit of support. So I always like to note those just because maybe next time, sorry, this time next week, we might be sort of looking at a level that's either broken and, we'll get a better sense of where price action might take us next. At 6:30, we go 30 minutes with this. Typically, we'll just hold out for 2 seconds for anyone who might have a question for us. In fact, I think we've got a couple. Um, there we go. This is an interesting one. It's a little bit more abstract, but just to start with, I don't really get bond markets. Is there any reading material you would recommend? Monty, you said you've got your economics hat on every so often. Um, I really like reading anything post-Keynesian when it comes to the bond market. Sometimes it falls into the sort of MMT camp, but um, anything that kind of uh, looks at the bond market from a sort of what would you call it? Financial flows perspective is the most interesting. Anything kind of you've read in the past, or perhaps when you were a teacher, Monty, Dr. Safedeen, we'll call you doctor for now, just for fun. Anything that you would have recommended to your students, knowing that I think we can recommend readings. We can't recommend trading ideas, but we can recommend readings, I think.
Yeah, thanks a lot for the doctor part. I'm not a doctor. I wasn't a PhD program. I'm not a doctor, but you just made all my other fellow grad students jealous by saying that. If you said professor as well, that would have signified like I'm a full-time professor, but I'm
Yeah,
not.
you got tenure for that as well. I've given you your doctorate and tenure all in the one conversation.
Thank you very thanks, Kyle. Interestingly enough, so the stuff I used to teach them was mostly the micro and the macro courses. We didn't touch too much on the bond market. So a lot, and I mean, I did go through a lot of books. Believe it or not, I don't remember the names of the books on the, like, it wasn't a book specifically on the bond market. It was sort of the bond market was within financial markets or the economy. So I don't have a specific name per se, unfortunately. But I think that if you don't really get the bond markets, one thing to do is, and this goes for anything you're learning if it's new to it. And even I'll say this as someone, as an economist, if there's some concept that I didn't get within economics and I studied and taught economics, you just read it a second, third, fourth time. Don't feel like if you read it the first time it's like what on earth is this? That's just the way it is. Read it. I would suggest just pick it up, go read it once, put it aside, just something basic about, what are bond markets, put it aside, pick it up again the next day, read the same thing again, do it 2 or 3 times, 4 or 5 days in a row, and then start tracking one, like say the US 10-year, for example, and just look at the flows from day to day and start getting to understand it. And I think little by little, I prefer that approach just because then it feels more second nature in terms of someone just saying, this is the bond market. You actually feel like you know the bond market a whole lot more. And that I felt like for me, that helped me get to understand the bond market a lot better than when I read about it, back in the day. And no, I didn't really teach much about it, but had I taught it, I don't think I would have really grasped it the way I am today after seeing it day in, day out, the whole curve, with, the front end tracking, monetary policy, the long end, growth versus term premium and all those concepts, those come later. But I think a sort of spoon feeding yourself little by little and looking at the market might be the better approach when it comes to the bond market.
Yeah, that's a really good point. And perhaps something that I'd add when I try to learn new concepts with work or just from my own interest is I find ChatGPT is fantastic to almost externalize your inner monologue. So get it there and literally ask it the dumbest questions that you possibly can, and then just ask it to continue to elaborate. And then, like you said, I think the best thing that you can do in financial markets in general is just stay across the news flow, and you start to get that kind of more intuitive feeling of what's actually going on rather than trying to read something in the abstract and understand it at a very, high but cerebral level that doesn't always make sense. We'll leave that one there. Perhaps we can try and find some, good book recommendations about the bond market because there's all sorts of elements to it. But there is a question, and we should, I should have picked this up given the inquiries that I was getting from the media today about the Japanese yen given the political turmoil that we've seen in the last few days in Japan, I'll give a little rundown in what I think. And that is to say that one, the reason why Ishiba lost his job was because he obviously failed to secure a majority at the last election. One of the reasons around that was some difficulties in trying to perhaps not reform, but consolidate the Japan's public finances. There was a sense that there was also a popular move among some within the LDP of greater fiscal spending. One of the reasons why the yen has depreciated is really on the basis that interest rates are still very low in Japan. If you listen to the Bank of Japan governors, so if you listen to Ueda and their commentary in every meeting they've had since basically hiking interest rates, whenever that was last, the real rates are quite negative still. So that's to say that they think policy in real terms is actually rather loose. That fiscal spending adds to inflationary risks that are already present in Japan. The inflation rate in Japan is about 3%, depending on the metric that you look at, and moving away from target. And there is this sense that neither the fiscal authorities or the monetary authorities are doing enough to step in to manage that situation, or at least, bring inflation back under control. And there is a fear that Ishiba might be replaced with someone who is even more lax, perhaps, from a fiscal policy perspective. My view on this overall is that eventually the Bank of Japan is going to have to step in into the fray and basically hike interest rates on the basis that inflation is moving out of control, and they're just going to have to put their big boots on eventually, or the big boy pants on, and actually hike rates, and that'll push the Japanese yen higher. I also think that the fact that we're seeing a weaker US economy is going to weaken the dollar too, and those spreads will start to converge. But that's why we're seeing that kind of dynamic at the moment. The initial move in the yen was to actually depreciate again because of those fears of even more lax fiscal policy in this low interest rate environment. I can see now that we're actually sort of unwinding those moves now, so we might be back in a more neutral sort of position, with all the news having been kind of digested by the market today, or the markets might be just moving back to focusing on the US dollar. Right, that was a bit of a monologue there on Japan. We've run over time. We might leave it there in the interest of Monty having to get back hard to work, because as you can see, my day is finished, whereas Monty has to continue to work hard. But hopefully we'll get him back soon. Monty, thanks so much, mate, for lending us your expertise there.
Thanks, Kyle. It's been a pleasure being here. And one of the guys mentioned, and he said that would it be possible to increase the volume? Yeah, I'll try and get some. I'll try and fix that one up. Sorry about the volume, guys. We'll try and get that one sorted next time. Get a proper mic.
Yeah, well, it's typical me anyway, trying to shout over anyone else who's talking. So I'll try and lower the tenor a little bit as well. But anyway, great chat. Hopefully we'll do it soon. And there was a question a little bit earlier. Oh, that's some boxing. I don't know what that is. There was a little bit of a question earlier about where we can find these webinars. You can go onto YouTube and to listen to these back. So please do like, follow, subscribe, tell your friends. But otherwise, we'll see you next week. And Monty, enjoy the rest of your day.
Thanks. You too, Kyle. Good luck, everyone. Happy
Cheers.
ticks.